Hey everyone, it's Daniel here from Infovest, keeping you updated on the economy and the news and the markets. I want to come out and just talk to you about the CPI report and the US inflation report that came out. And I want to start off by saying the recession is canceled. It's canceled. Recession is canceled. We're not going to get a recession. Biden told us, right? 2 months of negative quarter GDP is not a recession. Jobs are good. CPI inflation, last month it was 9.1%, but now it's 8.5%. Canceled. Actually, Biden just came out and said inflation is 0% since last month. So it's canceled. So no need to watch this anymore. No need to watch this video. No need to watch other people out there because no need to see the data. No need to pay attention to that 10 to 2 year yield curve. Don't need to pay attention. This time is wrong. This time is wrong. This time is different. Actually, I should be saying that. This time is different, not this time is wrong. This time is different. The media is going to come out, tell you this time is different. Biden's going to come out, tell you this time is different. Who else is going to tell you that this time is different? Well, don't take advice from me. I'm just a guy with a camera, look at markets time to time. Maybe I don't know much, and I could be wrong, and I'm not. This is not financial advice. I'm not giving financial advice. But I do want to comment on how the markets are reacting and what the CPI inflation report means. Now, if you haven't already guessed so far, everything that I just said so far is sarcasm, so please don't take that seriously. I'm trying to add maybe a little bit humor into this. Maybe it's funny, maybe it's not. I don't know. I'm test running it. But anyways, I want to talk about the US inflation report, okay? We got the US inflation report. The core number, the headline number, came in weaker than expected. I'll put the link there in the description. You could check out the full report there. The report talks about that the gasoline and natural gas prices have basically come down last month, and we've seen that. We've seen crude oil come off quite a bit. When you drive around to the gas stations, we see prices have come down. So it's a no shocker there, right? For sure the CPI report would reflect that. And it did. It came in at 8.5% headline year over year versus the 8.7 expected. So less than expected. Last month, right? The last report came in at 9.1%. So now we're having people saying, oh, inflation has peaked, inflation has peaked, inflation has peaked. And I'm not saying it can't happen. It can definitely happen. We can probably see inflation come down from here, definitely, or stay elevated, right? But definitely we shouldn't jump to conclusion. And I think it's too premature to be calling inflation has peaked and to be calling that, okay, the bottom is in and let's go long and blah, blah, blah. Sure, it can be. Definitely. I can be 100% wrong here on YouTube saying that it hasn't peaked, and saying that this is, we're out of the bear market, we're still in a bear market, and the markets could still crash, and whatnot, right? But of course, we'll have to continue to watch data. We'll have to continue to watch what the Fed has to say, and I think from now here on and forward, sure, inflation can become weaker, but my interest now has gone towards what is the Federal Reserve going to do if inflation continues to soften. Now, the markets are predicting that if inflation continues to soften, growth continues to increase. It tells you that the economy is absorbing the rate hikes. It tells you that inflation is getting better, growth is getting better. The yield curve that is in a deep, deep inversion is probably wrong. That's what the markets are saying and pricing in. And this huge rally that we saw in stocks and bonds is the reaction of a weak CPI. And the thing is, since June till now, it's August, we've been having basically a massive rally in equity markets already, right? So this whole move is on the basis that inflation is eventually going to come down. Growth is still strong. It doesn't look like any recession here, and it doesn't look like, and it looks like inflation is going to come down, and it doesn't look like that the market's going to crash any further. And if inflation is coming down and growth is strong, and we don't have to be doing 75 basis point rate hikes, 50 basis point rate hike, we can soften it. Probably the markets are pricing in that the Fed is going to slow down its rate hikes, slow down the pace at what they're doing with their rate hikes, and then eventually next year start cutting rates. So has the recession been canceled? Are we done with the recession? Is it over? Is it completely gone? Do we just take that file in our file cabinet and take it and throw it underneath the bed or the garbage or whatever? Is it done? And I think my answer is it's too premature. It's too early to be calling that the recession is over. It's too early to be calling that inflation has peaked. Sure, it has peaked from 9.1% down to 8.5%. Okay, I understand that. But doesn't mean that it's gone. Doesn't mean that the job of the Federal Reserve, right, is finished. They're not finished. They're not finished. It still needs to go down to their target of 2%. And we did have Fed members come out. Bullard did come out. Bowman did come out. They did come out. Bowman came out over the weekend, right, and said that, we probably, 50 basis points, 75 basis points still on the table. We still need to do sizable rate hikes, and we still need to increase interest rates because our job is not done with inflation. Same thing Bullard said, 3.75% to 4% is where we want to go towards. 4% by next year, probably cap out around 3.7% this year in terms of interest rates. So we're not done. So the narrative of hiking rates is still going to be there. And also come September, the quantitative tightening, the selling of bonds, right? The maturing of the bonds, the selling of the bonds, and possibly Fed members are going to start talking about selling of bonds. But the quantitative tightening amount on the balance sheet is starting to increase by September. That's what they planned out. So we're still not out of the woods. I wouldn't say we're out of the woods completely. I wouldn't say that this one CPI report is it. It's done. Now, for sure, the media is going to come out. They're gonna blast it out. The Biden administration is going to blast it out. They're going to show it in the news, right? And then guess what? Midterm elections are coming up. They're going to tell you, look, prices have come down. Biden's amazing. He's a hero. Blah, blah, blah. Right? And it doesn't mean it's over. It is too premature. I mean, look at bonds now, right? After the CPI report, we're seeing bonds come off. I mean, bonds did go up, but we're seeing some profit taking and some selling happening. What I want to see after the CPI report, do we continue this rally in both bonds and equities? And if we don't, might signal to you that this report doesn't matter. Now, it may matter more once we get the other CPI report. We still got more data to look at, September especially, right? So we have another CPI report that we need to take a look at, and we'll wait for that to get more information. But we're not out of the woods. The recession is not canceled yet. We may get more information of that later on. We may get more information that, okay, sure, maybe it is looking like that we're not going to have a very ugly recession. It's going to be mild. But definitely, you can't just look at one CPI report and say that's it, and that's the end of it. There is more information that you need to continue to monitor. And most importantly, monitor the Fed communication. They're telling you there. This one report doesn't matter. This one report doesn't, they need to see multiple reports and then decide if they're going to slow down on the rate hikes or completely stop raising rates. Now, if you guys remember, a couple years ago, I think it was just 2 years ago, really, but the average inflation target, AIT, was introduced. And what is the average inflation target? They basically said that they wanted inflation to overshoot so that the average number moves up. Now, since they let inflation overshoot, and obviously we've seen inflation increase and it's gone to 9.1%, what do you do to reverse that? You do the same thing. You let inflation come off. What's the opposite of overshoot? Is it undershoot? I don't even know if that's a word. But undershoot, if you want to use that, or you let inflation deflate so much for a couple of months and you let that happen. You let it roll a couple of months, keep going, lower and lower to maybe bring that average down, right? Because what is an average? You're taking multiple series of numbers and then dividing it by the amount. So it's not just one number and then boom, done. That's it. Here you go. It's multiple numbers. And then you take the average and see how the average inflation is doing. So I think there's a little bit of a mispricing here from the markets, and there's a disconnect with what the Fed has, and you're hearing versus what the markets are perceiving, and you're hearing a lot of Fed members come out other Fed members come out and try to give this information to the market, saying that it's not over. We're still gonna raise rates. We still want to reach go far out out of that neutral zone, and we're still going to continue to raise rates. And now, what does it mean in terms of the recession, in terms of growth? Now, there's a lagging effect with interest rates. It'll probably take about 6 months for it to see the full effect. So that means that probably by next year, we'll see if, when we get rates to 3%, we'll see the effect of 3% into the economy, into the markets by next year. So that means September, October, November, December, January, February of next year, you might see the effects of 3%, and then so on, right? So, it's not over. The recession is not canceled. This may not be the bottom that we've seen. We still can see a move down. And for anyone who is worried or maybe a bear in the markets, right? From a bearish point of view, you might be looking at this and saying that this rally in the markets, if everyone is going from net short to net long now, that kind of can cause maybe this blow off top, where if we do end up rallying and making new highs and everyone's caught off guard, and let's say by next year, growth in data just boom, collapse completely because of the effects of rates, because rates are moving up, and the Fed comes out and says, hey, we're not stopping, we're going more, we're raising rates, we're tightening more, we're doing balance sheet runoff, we're selling off the bonds and whatnot, we're creating tightening, because the market's going up is when the Fed talks about financial conditions, that is somewhat easing when the stock market goes up, right? The fact that the Reddit buyers are coming into the market, buying AMC, buying all these stocks, shows you that there's spending in the markets and people are optimistic, right? So that doesn't create tightening conditions. So if the Fed continues to raise rates and they continue to continue its tightening path, that might throw off the markets, and then that could cause maybe that unexpected sell-off that people are anticipating, or that recession that people are waiting for, right? We're in a weird time right now. Yes, GDP is basically two negative quarter GDP, and you do have jobs data and growth jobs growth is still strong, jobs data is still strong, but if that number starts to really deteriorate by next you know, next couple of quarters and rates still continue to go up, that might cause a lot of fears in the market. So we're not over. It's not over. It's not done. This is what I wanted to say on this video. I just wanted to conclude it is nowhere near close. Go listen to the speeches that Bowman and Bullard and all these Fed members that are coming out. Continue to watch what they have to say, because it might be a complete disconnect between what the Fed is saying and what the market is thinking. Now, if the market is right in terms of rate cuts are to come, and the market does, cause the Fed to slow down and ease right away, then sure, then great. As a bullish and as a bull, right? You can continue to go and buy your dips and continue to long stocks, crypto, gold, and whatnot. But I think it's too premature and too early to make any of that kind of decision. So anyways, hope this was insightful. If you have any questions, feel free to leave it in the comment section. If you want to comment and give me your thoughts on what you think about the CPI report, what do you think about the recession? Is the recession canceled? Is it not? What do you think about the yield curve? What do you think about all of this data? Leave a comment below. Subscribe if you like this video. Give it a like as well. And I hope to send off more and give more information on different topics in the next coming videos. Anyways, I'll see you guys around. Good luck and bye.